The global financial system appears unshakable, yet history proves that massive debt can quietly erode the foundation of money. Ancient empires and modern superpowers alike have collapsed under the weight of borrowing that seemed sustainable at the time. Trust, once lost, can unravel economies faster than any policy can respond. In 1971, the United States severed the dollar from gold, abandoning the Bretton Woods system. This move unleashed decades of monetary expansion, creating a paradox between apparent stability and hidden fragility in the global financial system. Confidence became the real currency, more than gold or paper bills. Today, the U.S. national debt surpasses $35 trillion, dwarfing the GDP of most nations. Despite this, the dollar remains the world's reserve currency, masking risks that could destabilize global trade and finance if confidence falters. Every borrowed dollar adds tension to the system's fragile equilibrium. Central banks worldwide injected trillions into economies after the 2008 crisis. While these measures stabilized markets, they also hid structural debt, currency, and banking vulnerabilities, creating a tension similar to a wound under a temporary bandage. The true costs may emerge when confidence finally falters. In 1923, Weimar Germany printed massive amounts of money to pay reparations, triggering hyperinflation. At its peak, bread cost billions of marks, illustrating that uncontrolled money creation can destroy purchasing power in months, not years. Historical lessons like this remain eerily relevant today. Even modern economists warn that similar mechanisms exist in today's complex monetary systems. When sovereign debt grows beyond productive capacity, structural collapse can occur despite technological advancement or political stability. Debt is a slow-acting poison in any economy. Global trade depends on confidence in currency, yet trust can vanish overnight. History shows that once faith erodes, currencies collapse, banking systems fail, and markets seize up, demonstrating that perception drives value more than fundamentals. Low interest rates appear to make borrowing safe, but they mask underlying fragility. Governments and corporations can borrow seemingly endlessly, inflating debt without immediate consequences, yet this creates long-term risk hidden from casual observation. Japan demonstrates this paradox, with public debt exceeding 250% of GDP yet remaining stable due to persistent confidence. While the economy appears resilient, structural vulnerabilities remain, and a shock could trigger a sudden crisis similar to historical precedents. Trust is fragile, not guaranteed. Inflation often lurks silently, eroding the value of money and debt simultaneously. Coupled with mounting obligations, inflation can destabilize even sophisticated economies, illustrating a universal economic mechanism repeated across time and geography. The recurring pattern is clear: debt accumulation, monetary expansion, inflation, currency stress, and banking instability. These mechanisms interact predictably, producing crises when ignored, yet policymakers often fail to recognize them until it is too late. Lessons of history go unheeded. Even mighty empires like Rome and Britain succumbed to these cycles. Their collapses were less about resources and more about financial structures failing to sustain escalating obligations, proving that debt patterns transcend era and technology. Modern financial instruments, including derivatives and complex bonds, mask risk rather than eliminate it. When stress occurs, these tools amplify instability, transmitting shocks across sectors and countries faster than ever before. Globalization multiplies vulnerability. Quantitative measures confirm this fragility. Debt to GDP ratios, inflation trends, and currency valuations indicate systemic stress long before collapse occurs. Observing history and metrics together reveals that economic patterns are predictable, even if ignored. Global reserves dominated by the US dollar create the illusion of security. Reliance on a single currency concentrates risk, so any loss of confidence can trigger cascading crises internationally, proving that size does not guarantee stability. Perception of safety often misleads investors and policymakers. Confidence can sustain an unsustainable system for years, masking risk until sudden correction becomes inevitable. The calm is deceptive. Historical parallels, from German hyperinflation to Argentina's 2001 default, illustrate universal debt dynamics. Nations ignore structural limits until defaults, inflation, and banking failures force abrupt corrections, revealing that patterns repeat despite context. Every financial system depends on trust, yet trust is fragile under constant fiscal expansion. Once confidence collapses, economies unravel with startling speed, affecting trade, employment, and the real lives of citizens. Low interest rates intended to stabilize often encourage more borrowing, inflating systemic risk. Policymakers unintentionally plant the seeds of future crises while addressing short-term pressures, repeating historical mistakes. The stage is set for the next major shift, as modern patterns echo those of history. Recognizing these warning signs is critical to understanding why money itself may soon face structural breakdown. Debt accumulation follows a predictable cycle. Governments borrow beyond GDP growth, central banks expand credit, and markets gradually sense imbalance. The tension builds quietly until sudden disruption occurs, as every historical crisis demonstrates. Credit expansion fuels temporary growth, yet real economic productivity often lags. This creates conditions where debt service becomes unsustainable, producing crises that appear sudden but are actually inevitable. Inflation emerges naturally from excessive money creation, reducing the real value of obligations. Cases like Weimar Germany and Zimbabwe illustrate the human cost of policy decisions unchecked by fiscal discipline. Currency devaluation is often deployed to ease debt burdens, yet it increases import costs and pressures domestic economies. The feedback loop between debt and currency destabilization has repeated throughout history and continues today. Banking systems are particularly exposed to these cycles as excessive lending amplifies risk. When borrowers default or confidence falters, liquidity crises cascade, demonstrating the interconnected fragility of modern finance. Sovereign debt crises often arise after prolonged fiscal expansion. Governments assume debt is manageable until obligations surpass productive capacity, revealing structural instability hidden beneath surface growth. Short-term political incentives often conflict with long-term fiscal reality. Leaders borrow to stimulate the economy or fund programs, while ignoring the consequences for future generations, repeating a pattern seen globally over centuries. Debt monetization amplifies risk, as central banks purchase government bonds to lower interest rates. While effective temporarily, this creates inflationary pressures that weaken currency value over time, echoing historical mechanisms. Credit bubbles form alongside these cycles, with lending optimism creating unsustainable leverage. When bubbles burst, defaults and liquidity mismatches trigger recessions or banking crises, illustrating predictable cause and effect relationships. Governments often repeat past mistakes, responding to crises with more borrowing and intervention. Self-reinforcing cycles can take decades to correct, increasing systemic fragility, a lesson confirmed by historical patterns. External shocks, wars, trade disruptions, pandemics, accelerate debt crises. Even well-managed economies are vulnerable when structural debt imbalances collide with unexpected stressors, revealing the limits of policy control. Regulatory frameworks are intended to contain risk, yet often lag behind market innovation. Loopholes and insufficient oversight allow instability to accumulate quietly, ensuring larger crises when corrections occur. Reserve currency dominance can mask systemic risk, as nations borrowing in their own currency appear more stable. Yet reliance on foreign confidence introduces fragility, as loss of trust can trigger rapid adjustment and currency decline. Excessive debt drives austerity, tax hikes, and restructuring. Each response slows growth, increases social strain, and perpetuates cycles of instability, demonstrating how economic choices reverberate through society. Interest rate policy interacts with debt cycles, shaping incentives for borrowing and investment. Artificially low rates encourage unsustainable debt accumulation, masking risk until correction becomes unavoidable. Trade imbalances amplify currency stress, requiring continuous foreign capital inflows. If confidence wanes, capital flight triggers rapid economic adjustment, demonstrating globalization's double-edged effect. Even advanced economies face these dynamics. Japan's massive debt and low growth illustrate that perceived stability can conceal long-term vulnerability, emphasizing the recurring patterns of collapse. Negative interest rates in Europe challenge conventional monetary theory. Unorthodox policies aim to manage debt cycles, but carry long-term risks for financial stability and market confidence. Algorithmic trading and instant capital flows accelerate systemic risk. Technological advances increase efficiency, yet compress the time frame for intervention, amplifying volatility during stress. Historical debt crises reveal a sequence: excessive borrowing, monetization, inflation, currency collapse, banking distress, and eventual stabilization. Understanding the sequence allows early recognition of risk in modern economies. Global debt now exceeds $300 trillion, more than 350% of world GDP. Sovereign, corporate, and household borrowing together create fragility, echoing patterns that have historically led to crisis. The U.S. national debt alone exceeds $35 trillion, with interest consuming a growing share of revenue. High debt limits fiscal flexibility, reducing the ability to respond to shocks or recessions. Central banks expanded balance sheets post-2008 to trillions of dollars, stabilizing markets but masking vulnerabilities. This mirrors historical debt monetization, showing that interventions can only delay, not prevent, systemic stress. Global interest rates remain historically low, encouraging more borrowing. This feedback loop mirrors prior crises, where debt grew faster than productivity, warning of future instability. China's corporate and local government debt exceeds $45 trillion. Shadow banking, property over-leveraging, and unregulated loans amplify systemic risk, showing fragility outside the West. European debt vulnerabilities persist, with Italy, Greece, and Spain above 130% of GDP. Slow growth, aging populations, and banking fragility mirror historical precursors to financial collapse. Banking interconnections ensure localized crises can spread globally. The 2008 mortgage collapse demonstrates how stress transmits worldwide, a pattern still relevant in today's financial ecosystem. Inflation has returned as a major concern, with consumer prices rising sharply in advanced economies. Central banks face the dilemma of tightening without destabilizing highly leveraged debt, illustrating the tension between policy and risk. Currency pressures are emerging, particularly on the US dollar. Even reserve currencies face potential loss of trust, risking capital flight, trade disruption, and financial strain worldwide. Derivatives markets increase systemic complexity. Instruments linking multiple sectors create liquidity under normal conditions, but can accelerate collapse during stress. Balance sheets of major central banks exceed record levels. Fed over $9 trillion, ECB over $5 trillion. Expansion mimics historical debt monetization, showing repetition of patterns that historically led to instability. Emerging markets face debt stress as dollar-denominated loans become difficult to service. Turkey and Pakistan illustrate how currency mismatches amplify systemic risk under global financial tightening. Fiscal deficits widen globally, driven by stimulus and social spending. Structural imbalances create vulnerabilities, echoing crises in Weimar Germany and Argentina. Corporate debt exceeds $90 trillion globally. Slowing growth makes servicing difficult, risking cascading defaults across financial institutions. Trade imbalances exacerbate risk as countries finance deficits amid currency volatility. Globalization spreads stress quickly, proving interconnected economies magnify fragility. Even advanced economies are not immune. Japan shows that debt over 250% of GDP and persistent deflation mask risk, proving superficial stability can conceal structural vulnerabilities. Unconventional monetary policies challenge economic frameworks. Negative rates and quantitative easing can create temporary relief, but carry long-term systemic risks. Rapid capital flows, algorithmic trading, and technology amplify volatility. Financial crises can accelerate faster than policymakers can react, reducing time for stabilization. Patterns of debt, inflation, and currency stress repeat across history. Recognizing them is essential to prevent systemic collapse, reinforcing that crises are predictable, not random. Public confidence is the foundation of monetary stability. Persistent fiscal deficits, inflation, and opaque interventions erode trust, leaving even advanced economies vulnerable. Unchecked debt accumulation could trigger sovereign defaults. Perception alone can spark capital flight, currency depreciation, and market panic, amplifying financial instability. Inflation may rise as governments monetize debt. Historical precedent shows hyperinflation occurs when fiscal discipline collapses and confidence disappears, affecting millions. Banking systems remain exposed to cascading defaults. Depositors and investors lose trust, risking liquidity crises and global contagion across interconnected financial networks. Global reserve currency dynamics may shift if dollar confidence weakens. Nations could diversify into other currencies or gold, diminishing dollar dominance and causing geopolitical realignment. Pensions, savings, and fixed income instruments are vulnerable to inflation. Ordinary citizens may see wealth eroded, provoking social pressure and economic strain. Corporate defaults rise if growth stagnates amid high debt. Supply chain bankruptcies propagate through economies, causing employment and market instability. Trade imbalances worsen amid currency volatility. Import-dependent nations face rising costs, often leading to austerity or debt restructuring. Emerging markets are particularly vulnerable to capital shifts. Rising U.S. rates or dollar weakness can precipitate crises, echoing Argentina 2001 or 1997 Asia. Monetary policy may lose effectiveness when interest tools hit limits. Near zero or negative rates leave central banks little room to respond, increasing stagnation risk. Commodity prices fluctuate amid currency instability. Inflation spikes in essentials trigger social unrest and disrupt global supply chains, affecting the real economy. Geopolitical tensions rise as nations compete for capital and stable currency. Resource allocation and trade conflict exacerbate instability, creating regional risk. Debt restructuring becomes inevitable when obligations exceed capacity. Haircuts, maturity extensions, or selective default carry domestic and international consequences, affecting confidence. Historical precedent shows early intervention reduces collapse severity. Ignoring debt and currency fragility transforms manageable corrections into full crises. Financial contagion accelerates in today's interconnected world. Problems in one major economy quickly ripple globally through trade, banking, and markets. Hyperinflation is plausible in countries with excessive debt and collapsing confidence. Citizens abandon domestic currency for foreign alternatives or tangible assets, accelerating devaluation. Governments may impose capital controls to stabilize finances. These measures can contain short-term risk, but often reduce long-term trust and growth potential. Economic contraction occurs when debt stress reduces lending and spending. Defaults depress revenues and create a self-reinforcing downward spiral. Central banks may intervene with asset purchases or interest adjustments. Temporary stabilization cannot resolve underlying debt and confidence issues permanently. Social unrest frequently accompanies economic collapse. Inflation, unemployment, and wealth loss produce political instability, compounding financial stress. Ignoring historical debt and currency patterns invites repeat crises. Excessive debt, inflation, and declining confidence form a recipe for systemic instability. Financial collapses are rarely random. Debt, credit expansion, and currency stress follow predictable patterns that can be observed and analyzed to prevent surprises. Confidence is the true foundation of any monetary system. When trust in government, currency, or banks erodes, even advanced economies can unravel rapidly. Modern economies mirror historical collapses in fundamental ways. Excessive borrowing, liquidity expansion, and currency dependence repeat across centuries, highlighting economic universality. Advanced finance does not prevent crises. Derivatives, digital markets, and high-speed trading amplify systemic risk when debt and currency stress converge. Even stable reserve currencies are vulnerable. Reliance on a single dominant currency creates systemic fragility capable of triggering global adjustment. Cycles of debt, inflation, and currency collapse are human, not natural phenomena. Policy, political incentives, and fiscal discipline dictate the timing and severity of crises. Sovereign debt enables growth but can destabilize economies when excessive. Historical examples show unchecked borrowing produces stress that monetary interventions cannot resolve. Central banks mitigate shocks temporarily but cannot prevent collapse if structural imbalances persist. QE and emergency rate cuts delay adjustments but cannot eliminate systemic risk. Global interconnectedness amplifies contagion. Localized crises can quickly become international, compressing intervention timeframes and increasing systemic risk. Public confidence remains central to stability. Persistent deficits, inflation, and opaque interventions erode trust, and history shows confidence collapse, triggers rapid, severe dislocations. Economic fragility is measurable via debt ratios, inflation trends, and currency movements. Ignoring these metrics allows vulnerability to manifest suddenly, with serious financial and social consequences. Modern economies survive high debt only if confidence persists. Policy missteps, transparency failures, or shocks can catalyze rapid destabilization in otherwise stable systems. Crises resolve through structural reform, credible policy, and restored trust. Decisive action stabilizes nations faster, while hesitation prolongs economic suffering. Vigilance is essential. Markets and governments often underestimate risk because instability may remain hidden until severe, emphasizing the importance of early detection. Money is a reflection of collective confidence. When trust falters, the mechanisms of debt, credit, and currency unravel, impacting every sector of society. The modern financial system repeats centuries-old risk patterns. Understanding continuity reframes crises as predictable outcomes rather than random misfortune. Awareness and preparation surpass reactionary policy. Recognizing systemic risk empowers informed decision-making rather than panic. Collapse is avoidable if patterns are acknowledged. Monitoring debt, currency, and credit allows preemptive action, turning crises into manageable corrections. The final lesson is clear. Stability depends on sustainable debt, credible policy, and public trust. Ignoring historical patterns invites repetition, while vigilance ensures resilience. Even in complex finance, the principles of collapse remain unchanged. Studying history, understanding cycles, and monitoring risk allows society to navigate financial stress with foresight.